Houston Real Estate Radio starts right now.
Welcome back to Houston Real Estate Radio. We're back with Rick Veale of Ameripro Funding. We've been talking about reverse mortgages, and we're going to continue that conversation. This show is sponsored by The Perfect Light. They are a landscape lighting and mosquito misting system company. So if you have any landscape lighting needs, The Perfect Light is the place to go, theperfectlight.com. And if you need a mortgage, Ameripro Funding is the place to go. So Rick is here in the studio with us, and we have been talking, we're talking today, we kind of wanted to focus the whole show around senior housing and the needs of seniors, their real estate needs as they transition kind of to that last segment of their life and the last housing choices that they're going to make. And a reverse mortgage is one of the things that they can use in that process. So welcome back, Rick.
Well, thank you very much. I'm glad to be back, Shannon.
So what does it take to qualify for a reverse mortgage?
Okay. Basically, you have to be at least 62 years old, and if there are two borrowers, a husband and a wife, the age is of the youngest one is the one that determines. Once you're 62, the older you are, the more money you can qualify for. It's kind of like an actuarial table, as you will find in the insurance industry. So that a person at age 76 is going to get more money than a person at 70 or 65. The other thing is the house has to appraise for a certain amount of money. That's another qualification, of course. And you have to have a certain amount of equity, or not a certain amount, but you have to have significant equity in the home. But as far as the different kinds of programs, basically there are three. There is a fixed saver program which offers which offers a fixed amount or a fixed interest rate that the interest accumulates on a fixed basis for a certain number of years. Now, just on March 1st, the old fixed system was outlawed, and a new fixed saver rate was brought in. That was because they felt like a lot of seniors were getting a higher amount than they could manage, and the government decided that the closing costs on that one were too high, I guess. And so now you have a fixed saver program, which means that you'll get a reduced lump sum if that's what you desire. There's an adjustable standard program that the interest rate is an adjustable rate, which is very, very equitable right now because of the way low interest rates are. And then there's an adjustable saver program, which is pretty much set up the same way, but with lower closing costs. There's a trade-off. When you have lower closing costs, you get less money in the lump sum. So you kind of have to look at all the options, have them compared side by side. It's a very simple determination for the loan counselor to make. But the one fixed program that was the most popular program has gone away, and now the new fixed saver is the only way to get really a fixed interest rate. But the key to managing your money is, once you have a reverse mortgage, is what kind of payout do you get. Many people opt for a lump sum, and they end up with a lot of money that they have a difficult time managing. Mm-hmm. A nice alternative to that is getting a line of credit. The beauty of that is that you don't pay interest on that part of the line that you haven't accessed. I'm a senior myself. If my granddaughter is going to go to college in a couple of years, it would be better for me to take out a reverse mortgage utilizing a line of credit so that I could meet her college obligations every year. But I would only be responsible for the lien would only accumulate interest on what had been drawn. So that if she's there for 4 years, every year it may cost me $20,000 or whatever. But the first year, I'm only accumulating interest on the first 20, and therefore. So a line of credit is a very useful way for seniors to kind of limit how they need to manage the money. It's still there, available for their needs, but they don't have the burden of so much interest accumulation right at the beginning. They can take out a term payment, which means that they're going to get money for whatever term that they want per month. If they select a 10-year term, they're going to get a check based on their age, the value of their house, and their equity, and that sort of thing for 10 years or 15 years or whatever they select. There's a 10-year payment that meets an obligation or meets the needs of a person who needs a check for life. Again, depending on their age, they're going to get more money per month than someone younger. That's called a 10-year payment. And then there's kind of a subtle difference, one called a calculated term, which meets the obligation that a person might have for a certain amount of money per month. They may need, say, $500 a month, and the terms of the loan dictate for how many months they'll get that. So there are 5 different options that they can select. These are not widely known. Most people think a reverse is just there to give them a lump sum of money to pay bills, or perhaps the 10-year payment. But I think the line of credit is something that really needs to be marketed and educated to the public, because it offers less burden from a interest rate standpoint.
Which I know that you can go normally on your home and get a line of credit through like the bank,
right,
which is not a reverse mortgage. But you're talking about a reverse mortgage with a line of credit.
That's right.
What would be the determining factors on which way you go? Should you go with a traditional line of credit or a reverse mortgage line of credit?
It depends on your immediate obligations. In my example that I gave you pertaining to my granddaughter going to college, that would speak well to a line of credit, because I don't need all $100,000 or $200,000 at once. I only need a certain amount the first year, a certain amount the next year. Now, we did a reverse mortgage for a gentleman who wanted to buy a business for his disabled son. His son had lost his job in landscaping business, and the father wanted to buy a business, and he needed a lump sum. It was a very, very good transaction that got him over $105,000 that he had a use for immediately. Mm-hmm. And he's also employing 6 people. I'm very proud of that reverse mortgage. Mm-hmm. But so there's very distinct differences in need there. Mm-hmm. But it depends on what your needs are, whether they're immediate or long term, or unforeseeable. I mean, and you need counseling in all those areas.
So you'd be able to use, I mean, if someone wanted to just take out a small amount to perhaps retrofit their home to make it more handicap friendly, for example, put up ramps in and handlebars in, that kind of thing, would that be an option, or are they going to give you the whole mortgage amount?
The problem with a small transaction like that, James, is that the closing costs are probably going to make it a little expensive. I mean, reverse mortgages do require higher closing costs than traditional mortgages. And that's basically an FHA requirement. It's not a reflection of the lender in most cases. So if they knew that they were going to have needs beyond that later, then I would advise they look at a line of credit. Maybe let's say for instance they could qualify for $100,000 but only needed $20,000. If they knew they were going to have obligations down the line, then take out the line of credit, access the first $20,000 or whatever they need to get the house retrofitted, and then hold back on the balance. And if they never need it, they won't pay interest on it. Only when they access it will they pay interest on it. And then when they pass, that will also protect their heirs with a smaller obligation on the property.
I know there's a lot of seniors that want to age in place, so to speak, and stay in their homes that they've lived in and raised their families in. And sometimes the doorways need to be widened and that kind of thing. And it's good to know that a reverse mortgage could be used for that.
And another thing that you spoke about last segment that I really like is that if someone owns a property, let's say their house is worth about $90,000, they've lived there for 50 years, it's just not worth a whole lot now in today's market, they could sell that house that they own and take that money to go towards a new house and do a reverse mortgage on the new house.
Well, as we discussed in the last segment, that's the case in all states except Texas for the time being. Currently, there is a constitutional amendment that's passed out of the House Committee, JR18 is what it's called, that will allow, when implemented, for the purchase of a home with a reverse mortgage. Shannon, you're right. That could be done. And the beautiful thing is that the reverse mortgage will pay, ostensibly will pay a great part of the down payment or the sales price of the new home. So if their old domicile is paid off or close to being paid off and has suffered from market deterioration, they can go ahead and take what they can get, the market price there, and apply for a reverse mortgage on the new house, and will allow them to upgrade, get into a more modern home that they'll enjoy for perpetuity, hopefully.
Couple quick questions for you. Do you have to own the house outright to do a reverse mortgage?
No.
Just want to clarify that. Okay.
No.
And then also, is there a certain percentage of equity you need in the house to be able to do a reverse mortgage, or is it case by case?
Yeah, I think it's folly to think that you could get it done if you don't own at least 50%.
At least 50. Okay.
Because when you calculate the lump sum that's available, of course, any outstanding liens against the house have to be satisfied.
Right.
And we've never seen it work where people owe more than about 25% of the value of the home.
And it sounds like the biggest thing with the reverse mortgage is making sure you have that discipline to put away your taxes and insurance money every month to make sure you don't get foreclosed on for something so minor.
Precisely, Shannon, and that's why so many seniors have gotten in trouble with after having taken out reverse mortgages, because they haven't been educated to the point where they can set aside the proper amount of money to meet their insurance and tax bills. And maybe they'd had escrow accounts in the past that did that for them, but now they don't, and they really need to be made to make a commitment for that.
And if you do a reverse mortgage on your home and you're living there, and now you need to go to a nursing home, what happens? Does the reverse mortgage, does it have to be paid off at that point?
It does. The lien against the house has to be paid if you have to move out. And so in most cases the house will be sold. The good news is that with a reverse mortgage, it can never be more than the obligation can never be more than the appraised value of the home.
That's very good.
So that and your heirs are protected that way too when you pass. That they can never owe more than the house is worth, regardless of how long you've lived with this reverse mortgage. So those are essential elements that you need to understand too.
Rick, lots of valuable information. I'm sorry, I didn't mean to cut you off, but I definitely appreciate you coming on the show, and hope you'll come back sometime.
Well, I'm more than willing to at any time. I love my my relationship with Register, and you guys do a great job.
Thank you so much. I'm James Brown.
I'm Shannon Register.
And you're listening to Houston Real Estate Radio. Shannon and I will be right back after a short break.